higher gas prices, $2 extra on Netflix, and demand for workers' pay in grocery stores to be upped. What do all three of these things have in common? These are all signs of inflation. And who really gets screwed by inflation? Is it the upper class? No, in fact, it's actually the middle class and the lower class. So I've been thinking long and hard as to why inflation is happening so rapidly. We've seen all these headlines, but what is the actual root cause? Or what's the number one contributor to inflation? So I sat and thought, and I sat and thought some more, and I came up with this conclusion. The number one cause of inflation is because of housing. I'll give you 12 reasons why housing has increased by 19% in the past year. Then we'll talk about what to do with inflation and why minimum wage increases actually benefit the upper class more than the lower class and the middle class, and the double R effect that it has on the lower class. So the reason why housing is the number one cause for inflation right now is because if you look at humans' basic needs, there's food, shelter, and water. The world has been producing a lot more food than it has in the past, and we've had a lot of innovation in just farming. Nowadays, you don't really see your friends being farmers, because a lot of farming is automated by big machinery. On the water side, we haven't yet hit a crisis where there's not enough water to sustain the number of people. But on the shelter side, everyone needs a roof over their head, so there's always going to be a demand for housing out there. If you break down the housing problem right now into its core elements, it's essentially supply versus demand. So to give you a little bit of context about the supply side of the Canadian housing market, there are about 133,000 houses that were under new construction in 2021. And that's actually significantly higher than the past 10 years. The amount of houses built every single year in the past 10 years averages around 100,000 houses. So if supply has gone up, that means demand must have surpassed the supply increase. And reason number one for why demand has outpaced supply is the fact that we have record low interest rates. If you're looking for a mortgage right now, you're looking at around a 1 to 2% interest rate, which historically is really low. These are rock bottom rates. Point number two, during COVID, there was an increased demand for vacation homes. So these are second homes that people want to own in places like Collingwood, for example. Typically, these are cottages, and especially the ones that are on the lake, these home prices have increased dramatically because everyone wants to be on the lake. Point number three is that investors are looking to invest in real estate as a rental property. With record low interest rates, there's really no point in buying bonds or GICs. Rather, people are trying to invest in assets that will also appreciate in value, and it would be nice to get some sort of dividend. So real estate kind of satisfies that. Because real estate has been very hot, as well as your dividend is basically the rental income that you collect. Rental prices will always be in step with real estate prices, because rental properties are essentially investors buying into these properties and hoping to at least break even, if not squeak a small profit out from rent. Point number four is one that you've probably never thought about, but it's the fact that investors are buying real estate for Airbnbs. And if you look at the rates people are paying per night on Airbnb, Airbnb is a lot more lucrative than rental properties. If you got a 2-bedroom apartment, you might be able to charge around $2,000. But if you Airbnb that property out, you could earn up to $4,000 or even $5,000 a month. Right now, I think a lot of people who are buying real estate as investment are actually converting these homes into Airbnbs rather than rentals. Because I looked at the math, rentals right now, you don't actually break even on your cash flow unless you charge a really high rent. But if you do Airbnbs, you're going to be laughing in profits, assuming that your Airbnbs at least rented out about 80% of the month, if not more than that. Point number five is that immigration is also causing real estate to skyrocket. There are about 500,000 people who immigrated into Canada in 2021, and those people all need a place to live. And if you assumed all these people were families of 4, the amount of new construction is barely enough to house these new immigrants. And people who immigrate into Canada, they tend to go to the larger cities like Toronto, Montreal, or Vancouver, because there's a lot more multiculturalism and the chances of them finding people of their same race and speak the same language is a lot higher. And that's why metropolitan areas and the real estate around that will continue to boom even post-pandemic unless we somehow restrict immigration. Point number 6 is that people want to live closer to larger cities because there's a lot more variety of food, a lot more different stores that you can shop at, versus if you're in a small town, you might only have the corner store. So this ties back to the previous point, how real estate in the metropolitan areas as well as the surrounding suburbs will continue to increase post-COVID. Point number 7 is the fact that there's 1.3 million vacant homes in Canada, and that's about 8.6% of the homes out there. And the reason why there's so many vacant homes is that Airbnbs are considered vacant homes, as well as there's overseas investors who are buying homes here, squatting on them, and hoping one day down the road it will increase in value and they can sell it for a profit. Point number 8 is the fact that COVID has caused many businesses to shift from in-office work to work from home. And the fact that people are working from home, there's a larger demand for space. Roommates who used to live together in a 2-bedroom apartment, they probably broke up and found their own space. And same with families who are living in condos, they can no longer live in condos anymore because the mom and the dad might need an office. So they're looking for a detached home or at least a townhouse. Point number 9 is the fact that divorce rates have increased by 30% during COVID. And if you look at a married couple, they were 1 unit before and they lived in one single shelter. However, now they're divorced and each person needs to find their own place to live. Point number 10 is that people are giving up on some of their dreams and traveling or just getting married earlier or even settling down and having kids sooner than they thought they would. And all 3 of these events mean that they're looking for either an upsize in their house or looking for a new home. The next 2 points have to deal with the supply side of housing. And we could see that in the beginning of the pandemic, a lot of people were okay with just sitting at home and collecting that $2,000 check. So there are definitely a lot of people in the construction industry who would rather be laid off temporarily and not go back to work and collect that money. So worker availability as well as just health restrictions and stuff to be on site, these have caused housing to slow down in 2020. And we're only catching up in 2021 right now. And the last point is supply chain. A lot of the materials that were used for building houses, like lumber for example, were in short supply. So this caused a supply squeeze in the new construction of houses in 2020. As well as it also contributes to higher prices because with a lower supply of building materials, then the materials become more expensive because the demand is still the same or even higher. So house prices also have to follow that because builders are not going to build a house at a loss. So with all this doom and gloom with the housing market and prices continuing to skyrocket, well, what should you do? How do you combat inflation as well? One thing you could do is up your skills and try to get a higher paying job. If you're looking to buy a house right now and cannot stomach that down payment, you can also hope that after COVID's over, the demand will drop down. Or at least prices might stay stabilized and you can continue to save up for that down payment in the meantime. I think it's fairly likely that the housing market can't continue at this rate. It's just like stocks can't just continue to go up. Albeit over the long term, housing will always go up, but not at these 19% rates that we saw in this past year. Maybe something like 3 or 5% is somewhat reasonable. The last thing that you should do, especially if you're in the lower or middle class, is cut out expenses that are not necessary. The reason why the lower class and the middle class will always stay where they are no matter what is because they spend their money on non-productive assets. So the best way to build your wealth as a lower class or middle class person is by stop buying those luxury goods and investing your money into productive assets like real estate, stocks, or even equipment that could be used for starting a new business. And productive assets are essentially things that will help generate future cash flows. If you're going out there and purchasing something like Netflix every single month, honestly, I think that is a luxury, and if you can cut that expense out, you could be saving something like $240 every single year. So you might be sitting there thinking, why did he say that minimum wage increases will actually not help the lower and middle class, but help the upper class even more? Well, here's the reason why. Because when the lower and the middle class increase their wages, the upper class also is naturally going to increase their own wages because it's not really fair to them, and typically these people are in managerial positions and positions of power. On top of that, there's a lot more lower and middle class workers, and a lot of the jobs that they do are a bit menial. And right now with the technology boom, there's a lot more new technology coming out that can essentially replace these lower class and middle class workers. So the people in the upper class who are in management, they're looking down at the number of people that they have to employ in order to run their business. And they're like, how can I cut down on people? Because they take sick days, vacation days, and oftentimes they just sit by the water cooler and chat. So they're going to look to technology which doesn't get sick, doesn't take rest, and doesn't chat at the water cooler. So as minimum wage increases and these lower class workers become a lot more expensive to employ, those upper class people in management, they're going to look for ways to cut down on hours for the lower class workers. And that's why the wages of CEOs have been going up exponentially. As a CEO, you can come in, have power over the company, and steer it in a different direction, especially choose which technology might help your business run a lot more efficiently. And when they say it more efficiently, it's usually getting rid of those lower class workers who are doing menial jobs like packing things. And let's say that CEO is able to lay off 1,000 workers, The amount of wages that they're saving from those 1,000 workers is around $36 million or so. So giving the CEO a bonus of $2 million for him saving the company $36 million, well, of course, shareholders are going to want to do that because that means $34 million into shareholder pockets. So this is the first R in the double R effect, where they're trying to replace workers with technology. The second R in the double R effect is rising prices. If a company in the meantime can't find a way to cut their workers, they're just going to increase the price of their goods and services to cover the new cost of this higher wage. And when they finally find a way to lay people off, they're not going to cut their prices, because if they keep the prices the same and have less workers, well, the profit margins go up and this looks great to shareholders. Ultimately, the management and businesses, they always answer to shareholders first, and the workers are a little bit lower on the totem pole here. So that's why I choose to invest my money into productive assets, because the company that I work for, one day they can no longer need me and I'm out of a job. If you guys have never invested in your life, well, Wealthsimple Trade is the best platform out there for you, because you pay zero commissions, there's zero fees, and you can start with as little as $1 in the account. And if you sign up today, make a deposit, and start trading, you can get $50 for free. Links in the description down below. So with that, we'll segue over to my TFSA portfolio and all the stocks that I bought this week. So if you've been following along my Monday journey, every single week I reveal what stocks I bought in the previous week and what I'm looking to buy next week. So this past week I bought shares of Nuvei, Shopify, National Bank, D2L, and Metaverse. I also got a dividend from Algonquin Power Corp's VFV, or the Vanguard S&P 500 ETF, and Ryokan. Those dividends totaled close to $10. Now, starting my portfolio based on a 1-week performance, this past week the outperformer was NCHES, going up by 7%. However, my more riskier stocks like Well Health Technologies and DCM were down 6.25 each. Other than those three stocks, other market moves in my portfolio were plus or minus 2%. Now, adjusting the portfolio by the current market value of all my positions, looking at the lowest positions, I'm going to continue to add to National Bank just because I think they have strong growth ahead of them, being Canada's 6th largest bank. They have a lot of catching up to do, and they've had the highest growth out of all 6 banks in the past 10 years. I'll also be continuing to add to Nuvei, as the stock completely got pummeled by a short report, and we can see signs of recovery right now. Shopify is another one on my radar, and if we see the percentage returns ever since I started buying in, I'm down about 20% on this position. But Shopify, for the long term, I do think they're a great growth stock, and they have a very compelling story, and they were for a brief period of time the largest company in Canada on the TSX. Now I think Royal Bank might have caught up ever since Shopify dropped. So that about wraps it up for this week's video. If you guys enjoyed the video, remember to leave a like down below, as well as subscribe and hit that notification bell if you haven't done so yet. I've got a couple videos up on the screen if you guys want to check them out. I'll see you there. If not, keep up the grind and have a great day.